Picture two men sitting in the same break room. Same company, same salary, same Tuesday afternoon. One of them, let's call him Jake, has just put in an offer on a rental property. A 3-bedroom house in a decent neighborhood, 20 minutes from where he works. Purchase price, $250,000. He's putting $50,000 down. His mortgage payment will be $330 a month. He's already found a tenant willing to pay $1,800. That's $470 a month in profit. Before expenses, before repairs, before anything goes wrong. Jake is excited. Jake feels smart. The other man, call him Marcus, takes the same $50,000 and puts it into a total stock market index fund. No house, no tenant, no keys. He sets up an automatic contribution of $300 a month and doesn't think about it again. On day one, Jake has a property, a tenant, and a story. Marcus has a brokerage account and a confirmation email. It's not even close in terms of how it feels. But here's the thing. Nobody tells you in the break room, at the barbecue, or in the real estate meetup. Feelings and math are two very different things. And over the next 20 years, the gap between what this feels like and what this actually costs is going to change everything. Before we go further, this video is educational content, not financial advice. The numbers I'm about to walk you through are illustrative examples. Your situation is different. Let me show you something most people miss. When Jake tells his friends about his rental property, he leads with one number. $470 a month. Rent minus mortgage, simple subtraction, clean profit. That number is real. It is also almost entirely misleading. Because what Jake is quoting is his gross cash flow. What he's going to live is something else. Here's what the napkin doesn't include. Property taxes. On a $250,000 home in a typical U.S. market, you're looking at roughly $3,000 a year. That's $250 a month, gone before Jake fixes a single thing. Homeowner's insurance. Add another $1,200 to $1,500 a year. Call it $125 a month. We're already down from $470 to under $100, and the house hasn't needed a single repair yet. Now it does. Year 1, the water heater goes, $1,200. Year 2, a section of roof starts leaking after a bad storm. $2,800. Between tenants, the property sits empty for 1 month. That's $1,800 in lost rent, plus $600 to clean and relist. The general rule in real estate is to budget 1 to 2% of the property's value per year for maintenance and repairs. On a $250,000 house, that's $2,500 to $5,000 every year, not as a worst case, as a baseline. And then there's the cost nobody puts on the napkin. Jake manages this property himself to save money, which means he is now on call. He is answering texts at 10 p.m. about a broken garbage disposal. He is coordinating a plumber on his lunch break. He is driving to the property on a Saturday morning because the tenant locked themselves out. That time has a value. Jake just isn't counting it. After all real costs, Jake's actual net cash flow over the first 3 years is somewhere between $2,000 and $4,000 total. Not per month. Total. Over 3 years. Meanwhile, Marcus has done absolutely nothing, and his $50,000 with $300 monthly contributions and historical average stock market returns has grown to roughly $76,000. Same starting point. Very different math. Here's the part that makes this so hard to see clearly. Real estate doesn't just feel like a good investment. It feels like the right investment. And that feeling is not an accident. When Jake drives past his property on the way to work, he can see it. He can point to it. It exists in the physical world in a way that a brokerage account simply doesn't. When his friends ask what he's investing in, he has a story, a real address, a tenant, a plan. When Marcus says, index funds, his friends nod politely and change the subject. Nobody is impressed by a confirmation email. Real estate has social proof baked into it. It has the weight of generations behind it. Your parents probably owned property. Their parents probably owned property. The idea that owning land and buildings is how ordinary people build wealth. That idea is so deeply embedded that questioning it feels almost radical. And here's the thing. It's not wrong. Real estate has made millions of people wealthy. It continues to do so. The leverage alone is something the stock market simply cannot replicate. Jake used $50,000 to control a $250,000 asset. That's a 5-to-1 ratio. When that property appreciates, he benefits on the full $250,000, not just on his $50,000. By year 5, Jake's property has appreciated to roughly $270,000 to $280,000. His equity, the difference between what the house is worth and what he still owes, has grown to somewhere around $55,000 to $65,000. That's real wealth, and a meaningful portion of it came from using the bank's money. Marcus cannot do that. You cannot take $50,000 and use it to control $250,000 worth of index funds without borrowing on margin, which is a different risk entirely. So why does the math keep coming out differently than the story? Because leverage is powerful, and leverage is also the reason the hidden costs hit as hard as they do. Every dollar of that mortgage has to be paid, whether the tenant pays rent or not, whether the furnace breaks or not, whether the market goes up or down. The asset is real. The obligation is just as real. Let me walk you through the costs that Jake didn't model, because almost nobody does. Vacancy. The average rental property sits empty for roughly 1 month per year. That's not a disaster scenario, that's the average. During that month, Jake pays the mortgage out of pocket. He also pays for cleaning, touch-up repairs, listing the property, screening new tenants, and his own time to show it. On a $1,800 rent property, one vacancy month costs him between $2,400 and $3,000 when everything is included. Maintenance and repairs. The 1 to 2% rule is a starting point. Some years it's a 150 faucet fix. Other years it's a $7,000 HVAC replacement in August when the tenant is threatening to leave and you have no good options. You cannot postpone it. You cannot negotiate the timing. The system fails when it fails. Capital expenditures. This is the category that catches landlords completely off guard. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These costs are not surprises. They are scheduled. They are scheduled. They are coming. If you are not setting aside money every single month for these replacements, you are not running a business. You are running on borrowed time. Property management. If Jake ever decides he's done managing this himself, and many landlords reach that point, a property manager charges 8 to 10% of monthly rent. On $1,800, that's $141.2 a month. Gone immediately dollars a month those. Gone immediately. His cash flow, already thin, gets thinner. And then there is the risk nobody likes to say out loud. A tenant who understands the eviction process, and many do, can stop paying rent and remain in the property for 3 to 6 months while the legal process plays out. During that time, Jake pays the mortgage. He pays the utilities if they're in his name. He pays legal fees, and he collects nothing. One bad tenant can erase an entire year of profit. None of this is in the $470 number. All of it is in the investment. Let's step back and look at where both men end up. By year 10, Jake's property has appreciated to roughly $335,000 to $350,000. His remaining mortgage balance is around $166,000. That puts his equity at approximately $170,000 to $184,000. Over 10 years, after every real cost, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, Jake's total out-of-pocket beyond his original down payment is somewhere between $20,000 and $35,000. Marcus, with consistent $300 monthly contributions and long-run historical average market returns, which have not been guaranteed and have included years of significant losses, is sitting at approximately $165,000 to $180,000. He put in $50,000 up front, $36,000 in contributions over 10 years, $86,000 total, the rest is compound growth. And he spent exactly 0 weekends fixing anything. At year 10, they are surprisingly close. Jake might be slightly ahead because leverage is doing real work for him. But Jake also spent hundreds of hours managing his property. He took on hundreds of thousands in debt. He concentrated his entire investment in a single asset in a single zip code, dependent on a single local economy. Marcus is diversified across thousands of companies. He has never lost a night of sleep over a broken pipe. Now let's go to year 20. Jake's property is worth roughly $450,000 to $500,000. His mortgage is paid off or nearly there. His equity sits somewhere between $400,000 and $500,000, depending on the market he's in. After 20 years of maintenance, repairs, tenant turnover, taxes, insurance, and at least one major renovation, his total net profit from cash flow, the money he actually pocketed above what he spent, is somewhere between $40,000 and $80,000. Marcus's portfolio, a long-run historical average returns with $300 monthly contributions, again, not a guarantee, and including the years the market dropped 30 or 40%, has grown to approximately $420,000 to $460,000, to total contributions $122,000 over 20 years. The rest, $300,000 or more, is pure compounding. No debt, no tenants, no 2 a.m. phone calls about a broken pipe. When you compare total net worth at year 20, they are in the same ballpark, $400,000 to $500,000 each, roughly. But here's what that number hides. Jake worked for his. Marcus waited for his. And here is the line that changes the math dramatically. The one the competitor video buried in the middle and most viewers miss. If Marcus had increased his monthly contribution by just $200, bringing it to $500 a month, his 20-year portfolio jumps to roughly $550,000 to $600,000. No second property, no second mortgage, no second set of tenants. In the stock market, increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying another property, taking on another loan, and doubling your workload. That asymmetry is the hidden cost the napkin never shows. Now, I want to be honest with you, because that's what this channel is for. If I only showed you the math that favors stocks, I'd be doing exactly what the real estate influencers do in reverse. Cherry picking. And you deserve better than that. Real estate wins in specific, identifiable situations. If you are in a market where monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. If you are willing to treat it as a business, screening tenants carefully, budgeting for capital expenditures, building systems, the returns can exceed stocks, especially with leverage. If you use house hacking, living in one unit of a multifamily property and renting the others, you can reduce your own housing costs to near zero while building equity. That is something the stock market simply cannot do. And if you understand 1031 exchanges, which let you defer capital gains taxes by rolling profits into a new property, you can build a real estate portfolio in ways index fund investors cannot easily replicate. Real estate is not a bad investment. It is a misunderstood one. And stocks are not the safe, effortless path either. In 2008, the market dropped roughly 37%. In early 2020, it fell around 34% in a matter of weeks. If Marcus had $150,000 in his portfolio and watched it become $95,000, that's not a number on a screen. That's gut-wrenching, and the data consistently shows that most ordinary investors panic sell during crashes and buy back in after the recovery, locking in the loss at the worst possible moment. So here's what I actually want you to take from this. The trap isn't real estate. The trap isn't stocks. The trap is choosing either one based on a YouTube headline, a barbecue conversation, or a feeling without ever sitting down and running the full numbers for your actual situation, your market, your time, your temperament. Jake and Marcus both thought they were making the smart play. Neither of them asked the one question that matters. Did you include everything? Because one day, 20 years from now, you'll look at your net worth statement, and the number on that page won't care which investment felt better at the barbecue. It will only reflect what you actually did, with full information, and enough time. That's the real math. And now you have it.